Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies, Palantir Technologies, and Neostock. We will be analyzing 3 articles today, to where the first one is titled, Why SoFi Stock is an Easy Double from Here. So essentially, we're going to be talking about how the SoFi share price could double in their overall value. After that, we'll move on to talk about Palantir Technologies regarding their PS ratio and how some experts believe this company is undervalued right now, making it a phenomenal buying opportunity. Lastly, we'll go over the latest news updates and catalysts pertaining to Neostock and how some of their competition may be a better buying opportunity, but overall, Neo still seems like a very strong investment. So for more videos just like this one, go ahead and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. SoFi Technologies essentially operates as a digital bank, and many investors are scared and afraid to invest into the banking space, which would prevent them from investing into SoFi Technologies. However, luckily, SoFi Technologies is a very safe company according to their newer fintech peers, and they are enforcing their overall resiliency by diversifying their overall business model, thus distancing themselves from any of their competition and other less secure banks. Right now is a great opportunity, according to this author, to invest into SoFi Technologies, and he believes the share price could literally double. He even has a $22 price target on this particular company, giving this company a phenomenal upside potential for investors. But here's where I'm going to actually push back on the overall author. As a disclaimer, I own SoFi Technologies in my personal portfolio, and I currently have around a 4% allocation because I don't allocate more than a 5% portfolio allocation to any singular risky growth company, because anything beyond a 5% initial investment would be improper risk management, and it would cause me to take on unnecessary risk of potential losses. Now, I'm going to push back on the author here because I have no idea where he is getting this $22 price target. He's saying that it's a resistance level and that he believes the company could more than double in their overall share price and potentially reach $22. However, even though I am a SoFi bull, we should not listen to this. SoFi currently, according to professionals, should be worth anywhere between $5 on the low end and $10 on the high end. There is no reputable analyst who believes the company is going to surge up to $22 over the next 12 months. So I don't want information like this to cause people to overexpose or buy too much of this singular speculative growth company, thinking that it could surge all the way up to $22 at the end of the year. Honestly, that is just not in the cards for this overall company. However, considering the company is trading for less than $6 right now, if the company were to surge up to $10 by the end of the year once they become profitable, that would still be a hefty payday for investors. But I do want you to be aware of people who are trying to pump stocks like SoFi Technologies, and they're promising you things that aren't in the cards for this company. However, with that being said, I still like SoFi Technologies and I own them, and I like how they are further diversifying their business model, which is enforcing their overall resiliency despite this volatile macroeconomic environment we find ourselves in right now. SoFi Technologies continues to innovate on their overall savings and investing accounts, their financial planning offerings, credit cards and debit cards, as well as their overall loan segment. Plus, they have acquired a mortgage lender that we talked about named Wyndham Capital Mortgage, which is going to allow them to obtain a platform which is further going to digitalize their overall mortgage experience, thus driving even more traffic to SoFi Technologies to where they could cross-sell and upsell customers on other products and services that they offer. Overall, SoFi Technologies still looks to be in a very strong position, and although this author believes the company could literally double in their overall share price, I really don't see any evidence of this happening for SoFi Technologies, and he also doesn't cite any evidence or a catalyst which would cause the company to double in their overall share price. The greatest catalyst that we have had recently recently would be their acquisition of Wyndham Capital, as well as the news of how the company could potentially become profitable in quarter 4 of 2023. However, even both of these catalysts combined would not cause the share price to double. So I do think this author has his head in the clouds, and we as investors need to always make sure to do our own research. But even with that being said, the company is further diversifying their business model. It has great growth opportunity ahead of it, and I do think the company will increase in their overall share price over the next year or two, especially after they become profitable in quarter 4 of 2023. So I would love to hear your thoughts down below about where you think this company could surge to over the next 12 months. Right now, the share price is hovering at around $6 per share, but as of right now, I see no evidence of this company surging to $12 or yet alone $22 as this author states. However, I am bullish on this company, and I look forward to what this company will make of themselves in the future. Speaking about companies that could make something of themselves in the future, let's talk about Palantir Technologies, ticker symbol PLTR, which is a big data and analytics company that serves both commercial enterprises as well as government clients. Right now, in this video, we're going to focus on their price to sales ratio, or their PS multiple. Essentially, the PS multiple is calculated by dividing their market capitalization over their sales. A PS ratio that is rather high could indicate that the company is overvalued right now, while a low PS ratio could indicate that the company is undervalued, making it a great buying opportunity. As of right now, the company is currently hovering at a PS ratio of around 9.7 times, or a price to sales multiple of 9.7. And what would this tell us about the overall company? Well, we have to compare this PS ratio to their overall industry, and right now, almost half of all the software companies in the United States have PS ratios under 4.4 times, or a PS multiple of 4.4, meaning that Palantir comparatively could be looked at as overvalued right now, meaning that the share price could drop. But with that being said, we need to compare this to their overall growth regarding their revenues, because if they were to grow their revenues very impressively or very aggressively, their PS ratio will naturally fall, thus meeting the overall industry average, making it an excellent buying opportunity. So this all comes down to how Palantir is going to grow their overall revenues. And according to the recent revenue growth, they do have superior revenue growth compared to their industry average, meaning that Palantir is doing very well, and this also means that they have a justified price to earnings ratio. So despite it being over twice the industry average, Palantir is still very well positioned according to this article. The article even takes into consideration their revenue growth over the last few years, to where they had a year-over-year increase of around 24%, but collectively over the past 3 years, their revenues have grown by around 157%, meaning that as they rapidly grow their revenues, their PS ratio and price to sales multiple will fall further downwards, making it a better buying opportunity. For the year of 2023, we know that Palantir is set to generate between 15 to 19% revenue growth, while the overall industry average is set to grow at only 13%, meaning that since Palantir is outscaling and outgrowing their overall industry, they do deserve a higher PS ratio than the average PS ratio for that industry. But I do want to insert a word of caution here. Palantir is not growing at around a 26% revenue growth, meaning that since their growth is not double their industry revenue growth at 13%, they don't deserve a 2 times PS ratio. So in my opinion, I do think Palantir is overvalued according to their current share price. But there is hope, because as Palantir continuously scales, and once the macroeconomic economy bounces back, their revenues are anticipated to grow, meaning that their PS ratio will fall, making them even more competitive in their overall industry, and making them a better buying opportunity, to where this company could be looked at as undervalued. But as of right now, Palantir does look overvalued in their overall share price, meaning that investors should hold this company until they can scale into their overall accounting ratios, such as their PS multiple. So if you are in this company for the long term and you're not overexposed more than a 5% initial allocation, holding would be the best opportunity for you as of right now. However, if you have not invested into this company yet, then feel free to wait before you invest until they have a more attractive PS ratio. And if you are overexposed to this company, feel free to sell a little bit of your PLTR shares and invest into something more fundamentally solid like SCHD, VTI, VOO, QQQ, MTU, and other ETFs like that, which will build your wealth over the long term. But I would love to hear your thoughts down below about Palantir Technologies and if you are excited for the future of this company, because I certainly am. Lastly, let's talk about NIO Stock, which is an electric vehicle company located over in China. So we'll see what this author has to say about this particular company. NIO has multiple positive catalysts coming up, which should increase their overall share price. Right now, NIO is a part of the fastest and most rapidly growing EV sector segment in the world, which is located over in China. On top of that, NIO's valuation is very low. They're trading at a PS multiple of just 2, and sometimes it drops below a 2, making it an excellent buying opportunity. They are also projected to release new electric vehicle models, and their battery swapping system is very attractive to users, and this technology diversifies themselves and differentiates themselves from their competition, which is honestly one of the reasons why I like NIO. However, there are other positive catalysts that are going on for their competition, so let's compare NIO to their top competitors. And just to be transparent with you, I own NIO stock in my portfolio. It makes up around 2 to 3% of my portfolio right now, but I also own Li Auto and BYD because I invest into NIO for their battery swapping technology. I invest into BYD because they are a huge company over in China. They dominate the auto industry, and they also recently came out with a very cool supercar. Lastly, I invest into Li Auto because I do believe they have better marketing than NIO, and I believe they could continuously press their overall competitive advantage, which is why instead of just betting on NIO, I'm betting on 3 major EV makers over in China. But let's talk about NIO more. NIO has very impressive reviews from their overall consumers and customers, meaning that NIO's technology and vehicles are very competitive in the overall space. Many people have commented that they like the premium yet minimalistic look of NIO cars, and they're also much cheaper than a lot of their competition, giving them a cost advantage. On top of that, users have commented how the battery swapping station technology is far superior than charging stations because it's not only quicker and more efficient, but this allows customers to rent their overall batteries, thus making it easier to buy an electric vehicle and more affordable. For instance, when customers choose the battery swapping option, they save $10,000 on their electric vehicle's initial price because the majority of the price of an electric vehicle is due to the electric vehicle battery. But instead of buying the battery and you just rent the battery, instead you just have to rent it and pay for the battery swapping technology, which is only $136 per month, which is way better than paying $10,000 up front, making NIO extremely competitive not only in their overall cost basis, but also their overall technology, which diversifies them. And that's why I am investing into NIO, and it really separates themselves from their competition. Now, there is a pullback for NIO. For instance, it has been recorded that some of their vehicles only travel between 230 to 250 miles, which is not very impressive compared to companies like Tesla, which have a range of around 317 miles for their Model Y. So on that particular front, they don't seem impressive, but NIO does have other vehicles which are more competitive in this particular regard, and they are consistently and constantly upgrading and innovating on their battery technology. The author highlights that he does not like NIO and he would rather buy Li Auto, BYD, XPeng, Rivian, and Arrival. He says that Li Auto is rapidly growing by selling their electric vehicles in China, and I agree with him. He also says that BYD is very well positioned to continue their overall dominance. And like I said in the beginning, I own both Li Auto and BYD as well as NIO. He also highlights XPeng, which I am not a fan of. However, they do have very good autonomous driving technology. He highlights Rivian because they have a huge deal with Amazon, and he highlights Arrival. However, I am not very excited about XPeng or Arrival right now, considering that both of them have a lot more growing to do. Rivian also has decreased in their overall share price, and until they find a bottom, it's rather dangerous to invest into Rivian as well, which means we are left with Li Auto, BYD, and NIO, which are all the companies that I personally invest in. But clearly, my number one electric vehicle investment is Tesla, and even though Tesla is very overvalued in my opinion, the company still has so much potential upside. I believe they will grow into their overall valuation, and Tesla should be a multi-trillion-dollar company. But I would love to hear your thoughts down below about SoFi Technologies, Palantir Technologies, and NIO stock. Go ahead and annihilate that like button right now for more news updates just like this one. Subscribe if you are new, and I'll see you in the next YT video.